Well, folks, the Bank of Canada announcement overshadowed a more important report that came out on the same day that I think is more critical as to what is going on in our economy. The Angus Reed Institute published findings regarding how homeowners are feeling and what should we be bracing for ourselves in the coming 12 and 18 months. All this and your questions on episode 153 of the Wise Old Owl Show. So, the Bank of Canada met this week. Everybody's talking about it. We all know that we just got a big nothing burger, but it did tell us that we are going to be seeing some sticky inflation and we could be looking at higher rates for longer. Very important that everybody understands that the higher rates are going to be here for a while. And for anybody expecting any cuts in rates anytime soon, good luck. It's not going to happen. We are seeing the Canadian dollar drop considerably because of the stagnant Bank of Canada rate. That will cause imports into Canada to be more expensive. And of course, that gets passed on to the consumer. So we're going to see inflation still sticky in that 3 to 4 range. And seeing that come down anytime soon is it's not going to happen, folks. So I think we got to brace ourselves and be ready. But, you know, at 8:30, there was another report that came out that I think was more important on the day that the Bank of Canada announced at 10 o'clock. And that was the Canada Food Bank report published some startling numbers, and I just want to highlight these figures. Okay, number one, 32% increase in food bank usage in Canada. And as we drill down into more local numbers, a 50% increase in food bank usage in Toronto. Of those, 16.7% of people using food banks are employed, folks. These are not homeless people that don't have jobs. These are people that are employed and have wages. And 7.7% of those using food banks are homeowners. 48% of these folks have kids. And what is more depressing is all these stats are based on March 2023 figures and reporting numbers. So we're in October now, and these are stats from 6 months ago, folks. So it's gotten worse since then, and I suspect that these numbers are worse than what are reported. So I'm really keen on trying to get a grip of this issue, because it's very clear that there's a tremendous disconnect between what government is trying to shove down your throat and what is actually happening. When you have a part-time finance minister continuously telling us that we lead the G7 in certain aspects of our economy, that's a bunch of bullshit that Canadians don't really want to hear about, because we care about people here. We should be caring about what's happening in our country as opposed to comparing it with other nations around the globe. So folks, we are dealing with some very, very difficult situations in households across Canada, and more importantly in the GTA. And the reality is people are running out of money before they run out of month, and that's not a good sign. We really need to understand this crisis and why it's happening. And you know, when you look at other reports, the Angus Reed Institute, which is a nonprofit reporting agency, indicates that homeowners are 4 out of 5 homeowners are worried about their finances. 40% are worried. 39% are very worried about the fear of higher payments at renewal time. And this is really starting to creep into everybody's finances, because what's also occurring is that this whole narrative of climate change and the environment is dropping in priority with Canadians. The Angus Reed Institute claims that cost of living and inflation, healthcare, housing affordability, and taxes are running they're all running ahead of climate change and the environment issues. So the government needs to wake up. The government needs to understand what is really impacting Canadians, and hopefully, they could get a handle of this and really focus their attention on what matters most, and that is cost of living, housing affordability, and healthcare and taxes. So, we're going to keep an eye on this. It's really a concern. And one of the things that came out of that report too is that half of Canadians, 49%, are saying that they're in a worse position financially than they were a year ago, and 35% believe they will be worse off a year from now. So this is not a positive trend, okay? The trend is not our friend, and we need to start really focusing on our budgeting, our financing, to try to be proactive and getting a handle of this and being aware of what is coming over the next 12 to 18 months, because it will get worse. I do believe that we still have a bumpy road ahead of us, and the more proactive things that you could do with your budgeting, with your financing to prepare for it, you're going to be better off. So I really encourage you to take shape of your household expenditures and your incomes, and try to really understand your financial situation so you can really get a hold of it. I want to talk a little bit about OSFI. OSFI came out recently and indicated that they're not going to be doing any more tightening to credit criteria for mortgages, okay? There was some talk about some loan to income ratio and debt to income ratio qualification tools, and they've kind of said, no, we're going to let things go. They didn't indicate that the stress test is necessarily going to be impacted just yet, but we're hopeful that they're going to start thinking about that, because I really do believe we do need some help in that regard. And one of the things that I would be in favor of is eliminating the stress test in its entirety on 5-year fixed mortgages. If we do believe that the horizon for higher rates doesn't exceed 3 to 4 years, then I don't see why a stress test is required for a 5 or more year term on the fixed side. If you want to go with variable, you want to go with shorter terms, yeah, put in the stress test. Encourage people to have some certainty with their costs, and a 5-year term should probably warrant the elimination of a stress test. Now, having said that, I've always been a fan of the stress test during this period of time where rates kind of accelerated to the level they are. I think it was, it was a hero during this crisis. I really think it helped people from harming themselves by taking on more debt than they needed to, and I do believe it was good policy. But it was meant for a time when we were at low rates. We're now at significantly higher rates than where we were, and it looks like the Bank of Canada is indicating that we may be at the top or close to the top with rate increases, and they should consider that over the next 2 or 3 Bank of Canada meetings to see if there is stability at the higher end level with the Bank of Canada, and if so, maybe relax a little bit on the stress test on longer term fixed rates. So hopefully we'll get some relief in that regard. We've hit episode 153 of the Wise Old Owl Show. We're almost 3 years into this weekly podcast or show on Instagram, and I want to thank everybody for their continued support. A couple posts went viral in the last week, and I want to thank all of you for doing your shares, for forwarding it on to friends and family. I'm a little bit overwhelmed by and humbled by that success, but I just want to thank all of you. And my goal is always to provide you good quality content, drill down on data and stats to help you determine how best to handle your household finances. And if there's anything that you'd want me to look into or dig up or try to track, please send me a DM. I'd love to provide you any other content that you think would be useful. What else do we want to talk about? The Porsche Tracker. Porsche Tracker has gotten a lot of heat lately. People that drive Porsches send me a lot of DMs upset about the fact that I'm tracking these things, and the reality is they're claiming that most of these things are all Cayennes and SUVs that are being sold, but the reality is it's just a data point, okay? My point in tracking used Porsche sales is to solely indicate that trends tell you something. When you look at things at a macro level, you got to pick on some data points that you think could indicate a potential change in behavior. And with rising interest rates, what tends to happen is toys tend to be sold, getting rid of. People want to get rid of certain payment obligations and whatnot, and need to free up cash. So it was solely a point to try to illustrate that behaviors are changing. And when we started tracking in September 2022, the number of Porsches that were for sale was about 930, 940 available on AutoTrader. That number over the course of 13 months has increased substantially. It peaked at 1,311 a couple weeks ago. It's sitting at 1,240-ish today, and it's solely a tool to help everybody understand that the toys are being sold off. People are liquidating, freeing up cash to make other payment obligations and set their finances in order. So we'll definitely continue to keep an eye on that. The 5-year bond market, in response to the Bank of Canada's announcement, did come off a little bit, settled in at about 4.18. That's down from 4.34 last week and 4.20 2 weeks ago. So it kind of settled back to where we were 2 weeks ago. And that's a good sign. Things are starting to level off. I think it gives people a sigh of relief that the Bank of Canada held, and that's always a good sign. But we still have some challenges. 55% of the mortgage stock outstanding will be coming up for renewal in 2024 and 2025. These are all folks that are going to experience payment shock, and they're going to have to brace themselves for higher payments if they're going to be staying in the home and not pay down that debt and make lump sum payments. For those that are in static variable payments, they're going to be taking it on the chin. These are folks that are going to see considerable payment hikes to their monthly mortgage obligation, and that is because the negative amortization or the increased amortization beyond where they started from has to come in line as per OSFI's directive. Now, there could always be a change to that, and OSFI, if they see that things are a little bit shaky, could make some alterations in that regard. You got the federal government trying to push for some consumer protection guidelines and not have banks pressure people into making outrageous payments that they can't afford. But the reality is OSFI is there to protect the banks, and the banks need to do what they have to do to protect themselves and their covenants. And if we continuously see values trend downwards and put pressure on loan to values, it's only going to put additional pressure on banks to impose those OSFI rules and bring those folks into line on that amortization schedule. So there could be two pressure points here, and the walls could be closing in quite tightly if we start seeing values come down as we're seeing in most parts of GTA. I want to talk about some success stories before we leave off. Rehabilitation is something that we always strive for with clients. We had a success story, a couple success stories in the last month, where we had clients that had some bruised credit, had some back taxes, and we had to go to a home trust to put them in the penalty box, is what I say. They got to improve their credit rating, they got to get things up to date and get things back on track. So, we went to a home trust, which is an alternative lender that does have an appetite for those clients and want to help them. And, they got their renewal in the mail, came in at like 834, okay? But when we reassessed them, we're back at a good beacon score. They do qualify for a traditional mortgage, and we were able to put them into an A lender. We put them in at Scotiabank, and they were able to save a significant amount of interest on an annual basis of about $12,000 a year, almost $1,000 in interest a year. And they got free legals, free appraisal, and we got them back into the A game. And I call that a really good story because they played it out properly and rehabilitated their situation to get back to A. Unfortunately, we're seeing a lot of people going backwards, people going from A, wanting to refinance, no longer qualify because of the stress test, and going from A to alternative to private, and it's not going the right way. So really happy to see a few situations this month where we're going the right way and rehabilitating, and hopefully over the next little while we can see a few more of those stories. So if you do need any help whatsoever, please reach out. We're always eager to assist clients and give them some insight and provide them some guidance on how to forge ahead in this very, very difficult situation. And I want to leave you with this. The food bank's report hit home. I really am troubled by the stat. As you know, this summer we raised money for a homeless shelter, and it really moved us when we went down there to drop off all our non-perishable goods. If you have the resources to help out and you can make a donation to your local food bank, please do so. Be kind out there. People need your help. There's a lot of people struggling, and if you have the resources and the ability to do so, I encourage you to get out there and help these folks out. They need it. They're the ones that are struggling, and I'm sure they would appreciate it immensely. So on that note, have a great evening. Enjoy the weekend. See you next week.